There's a document that exists inside every major bank. It's not a secret, it's not hidden, but it's never advertised. It's called a customer behavioral profile, and it contains something banks have spent decades studying: the psychology of how people with limited money make decisions. Not to help them, not to protect them, to predict them. Because a predictable customer is a profitable customer. What you're about to hear isn't a conspiracy theory, it's documented business strategy, and once you see it, you cannot unsee it. Let's start with a number. The average overdraft fee in the United States is $35. The average overdraft transaction that triggers that fee, the purchase that pushed the account below zero, is $24. You read that correctly. Banks charge $35 to cover a $24 purchase. That's an effective interest rate of over 17,000%, annualized. And who pays these fees? Not wealthy customers. Wealthy customers maintain buffers, they never overdraft. The overdraft fee is specifically mathematically almost exclusively paid by people who are already struggling. In 2022, American banks collected over $8 billion in overdraft fees alone. $8 billion. Extracted almost entirely from the accounts of people who could least afford it. But here's what makes this more than just predatory pricing. Here's what makes it psychological warfare. Banks know exactly when you're most likely to overdraft. They know your paycheck schedule. They know your recurring expenses. They know the 3 days before payday when your balance drops to its lowest point. And that is precisely when they process transactions in the order most likely to generate multiple overdraft fees rather than just one. This isn't an accident. It was a deliberate processing strategy, documented in internal bank communications, later exposed in class action lawsuits, designed to maximize fee revenue from customers with the least financial cushion. To understand why this works so effectively, you need to understand something called present bias. Present bias is a cognitive pattern where the human brain assigns disproportionate value to immediate needs over future consequences. In plain language, when you're stressed about money right now, the future becomes almost invisible. Your brain cannot properly weigh long-term costs against short-term relief. A payday loan at 400% annual interest feels acceptable when your electricity is about to be cut off. The math doesn't matter, the urgency does. Banks and financial predators understand present bias better than most psychologists. They've studied it, they've tested it, and they've built entire product lines around it. Consider the structure of a payday loan. You borrow $300. You owe $345 in 2 weeks. Simple enough. It's only $45. But most borrowers cannot repay in 2 weeks, so they roll it over and over and over. The average payday loan borrower is in debt for 5 months of the year on a product marketed as a 2-week solution. The product wasn't designed to solve the problem. It was designed to extend it. And the reason it works isn't that poor people are stupid. It's that present bias is a universal human trait, and financial stress amplifies it to the point where even intelligent people make decisions they would never make under normal cognitive conditions. But banks aren't just exploiting present bias, they're exploiting something deeper. They're exploiting identity. Here's what decades of financial psychology research has shown. People don't just have financial behaviors, they have financial identities. A self-concept around money that was formed in childhood and operates largely below conscious awareness. For people who grew up in financially stressed households, that identity often contains beliefs like, money is always scarce, debt is normal, people like us don't build wealth, getting by is the goal. These aren't conscious decisions, they're operating assumptions, and they shape every financial choice, often in ways that confirm and reinforce the original belief. Financial institutions know this. The entire subprime lending industry was built on the insight that people with low financial self-esteem will accept worse terms, higher rates, higher fees, more punishing conditions, because they don't believe they deserve better. This is just how it works for people like me is one of the most profitable sentences in banking history. And the cruel sophistication of this system is that it doesn't need to convince you of anything. It just needs you to keep believing what you already believe about yourself. So what do you actually do with this information? The first thing, and the most important, is to recognize that your financial behavior is not a character flaw. It's a predictable response to a system that was specifically designed to produce it. That recognition matters, not as an excuse, but as a starting point for change that's based in reality rather than self-blame. Second, understand the specific mechanisms being used against you. Overdraft fees, minimum payments designed to extend debt indefinitely, promotional rates that revert to punishing ones. These aren't unfortunate side effects, they're the product. When you understand the mechanism, you can interrupt it. Automated savings that move money before you can spend it. Credit unions instead of predatory banks. Building even a small emergency buffer. Research shows that $500 in savings dramatically reduces the likelihood of entering a debt spiral. Third, and this is the deepest work, examine the financial identity you're operating from. What did you learn about money before you were 10 years old? What did you see? What did you hear? What did you conclude about what was possible for someone like you? Because those early conclusions are still running, quietly, in the background, shaping your tolerance for bad financial products, your willingness to negotiate, your belief in whether building wealth is even a realistic option. You didn't choose those beliefs, but you can choose to examine them, and examination is where change begins. Banks don't want you to think about any of this. They want you reactive, stressed, focused on the immediate problem, because a person in survival mode doesn't examine the system, they just try to get through the week. But you're here, which means something in you is already pushing back. The psychology of poverty isn't a life sentence, it's a set of patterns, learned, reinforced, and deliberately exploited, that can be understood, interrupted, and replaced. If this shifted something for you today, share it with someone who needs to hear it, and subscribe, because every week we go deeper into the psychology that the financial system hopes you never understand.